what I'm going to talk about is obviously what's on everyone's minds. This crisis that we face, or the aftermath of the crisis. So we went through a very, very frightening period, maybe 6 months or so after the fall of Lehman Brothers. And then the extreme period, the terror, receded, and many people said, "Oh, it's all fine now," but it wasn't. And we're actually, in some ways, in a more difficult time than the period of extreme crisis, because it's much harder to get agreement on what should be done. Very easy to let things slide. And so I want to talk about the nature of the problem we have, and the prospects looking forward, which I'm sorry to say I'm not very optimistic about. So let me start with the just a kind of indication of what happened and how far we still have to go. So this is for the three major advanced economies, treating the EU as a single bloc. This is what happened to GDP in the moment of in the crisis and its aftermath. Very severe downturn. Actually, most severe in Japan, which is surprising. Japan did not have a housing bubble. It did not have a financial crisis because they had their bubble and their financial crisis 20 years ago. But they got hit very hard by the decline in world trade and severe slump, followed by rapid growth, but still leaving them below where they were. Actually, Germany looks somewhat similar. Germany also had no bubble, no domestic financial crisis, severe drop in GDP because of loss of exports, fairly rapid bounce back, but still below where it was at the beginning. And as you see here, as of the second quarter of this year, all three major economies still below their production before the crisis began, and of course several years of growth should have taken place. If you try to measure how far we are below trend, the trends were slower in Japan and in Europe than in the US. So overall, we're all about equally depressed, and it's bad. I think if we were to make an estimate, the output gap in the United States is probably around $900 billion at an annual rate. That is the difference between what we could be producing if we had full employment and what we're actually producing is about $900 billion a year, roughly equivalent for Europe, smaller for Japan, but altogether $2 trillion or more of waste, of productive capacity not being used, coupled with very high unemployment. In the United States and in Europe, both about 10%. Europe is more accustomed to high unemployment. The U.S. is not. The U.S. safety net is terrible. So the tremendous amount of human suffering in the U.S., not as bad in Europe, but in parts, certainly in Spain, very, very severe hardship. This is not, what I'm showing up here, this is not recovery in the normal sense of the word. Technically, it's a recovery. If we ask, has GDP been rising? Yes, the recession is over. But we're nowhere close to having experienced a full recovery. This is not surprising. The history of what happens after financial crises is that they normally have long effects. It takes a long time to recover. So these are unemployment rates in three crises, widely separated in time and space. The blue line is the United States following the panic of 1893, which was the worst financial crisis until the 1930s. Now, if somebody may be informed enough to know that we don't actually have unemployment statistics for 1893, but this is an attempt to estimate based on fragmentary data, and it looks plausible. The red line is Sweden after its 1991 financial crisis. That's real numbers. What you would notice from both of those is, first, a large rise in the unemployment rate, and secondly, persistent. It took a long time for unemployment to come down after the 1893 crisis. Sweden in recent years has been a pretty happy place. Unemployment is fairly low. It's been looking good. And we look back at Sweden and how it handled the 1991 financial crisis, and it's regarded as a success story. They nationalized the weak banks, recapitalized them. They did well in dealing with their banking crisis. But the fact of the matter is it didn't start to look like a good story until years and years after the crisis. Sweden had a really bad employment story through most of the 1990s. And then the United States today, and the United States is more or less tracking exactly what you would expect. As some of us say, the United States is experiencing an average severe financial crisis. That is, the numbers are terrible, but they're terrible in a way that more or less is what you should have expected given this crisis. But unfortunately, if that's true, if history is our guide, then it will take a long time before things are actually okay. So if you look at, is Obama doing badly in running the U.S. economy? Well, no worse than you probably should have expected. But if you think about, when, given the way these things usually work, when should we actually really start to see serious, clear-cut improvement in the unemployment picture? And the answer, as I'd like to say for U.S. audiences, it's sort of late in President Sarah Palin's first term. It's going to be a long time before we really, in other words, we really would not expect to be seeing it until 5 years or so from now, before we really feel that this crisis is over.
I have several questions, of course, here, and I would like to put some order to them. Let me try and see whether I understood what's been going on. What's been going on is this. We get a beautiful talk. I should say not often we get talks about the crisis so well organized, so thoughtful, so deep. But the conclusion is, sorry fellas, nothing doing.
Yeah.
Well, let me spend 2 words on that, because you've been telling us that basically there are 2 ways out, 2 avenues out. One is policy and one is entrepreneurship. On the policy side, we have fiscal policy, we have monetary policy, and let's call it climate policy, just to exemplify. Yeah. Now let's start from the top and start from monetary policy, which leads me to the first question, because basically what you've been saying ever since the beginning of this crisis has been, to policymakers, look, you're not doing enough. It isn't enough. You're saying it to the Fed, you're saying it to the government, and up to this date you're absolutely correct. Not enough has been done. In other words, how big is the stimulus, this quantitative easing tool that we are talking about, that you think could be, in the medium-long run, inflationary enough to reactivate this economy?
Okay, so I did not actually talk about quantitative easing. So let's talk about that. So the quantitative, for those, I assume most people know this stuff, but so normally monetary policy takes the form of open market purchases of short-term government debt. And that's what's at its limit. Nothing more you can do. At this point, the interest rate on short-term debt is about 0. People, if you do an open market operation, you're just swapping one 0 interest rate asset for another. It does nothing. So actually, there were 2 versions of how monetary policy might get an effect here. One is to announce an inflation target and commit yourself to doing it later on, and which means that what you're basically doing is you're saying that once we're out of this, once the zero lower bound is no longer binding, we're actually going to hold off and let inflation rise thereafter. And that could make people more willing to borrow. That's what I was advocating for Japan 12 years ago. But that's proved to be very, very difficult because you can't, central bankers really hate the idea of promising higher inflation, and they find it really impossible to imagine committing their future, their successors, committing future central bankers to honoring those targets. So that hasn't been going anywhere. So what's on the table is quantitative easing, which is a terrible term, because it really what we really mean is qualitative easing. We mean the Fed or the ECB buying a different kind of assets. Real quantitative easing is what the Bank of Japan did for a while, which is they just stuffed the banks full of reserves, just hoping they would go somewhere, and it didn't happen. So we're talking instead about buying longer-term government debt, right? And that's certainly what the Fed is about to do. If you think it through, I think it's really helpful here to think in terms of the central bank and the finance ministry, so the Fed and the Treasury or whatever, as a consolidated balance sheet. And if you think that through, then what quantitative easing really amounts to is it's actually shortening the maturity of government debt. The Fed creates reserves, which is in effect short-term borrowing, uses those to borrow to buy back a bunch of long-term government debt. So what's really happened is that the consolidated unit has shortened the maturity of its debt. Think about it that way, and you become skeptical that quantitative easing on the scale we're talking about can accomplish that much. $1 trillion of QE by the Fed is equivalent to a 1-year reduction in the maturity of U.S. government debt. That will reduce interest rates probably 15 basis points maybe on the long-term debt. I mean, it's very hard, but we have some evidence from the past, and it suggests a modest impact, but that is really hard to get a lot of traction. So if you try to take this seriously, if you try to, here, since I actually have my pictures, if we actually ask what it would take to close that Taylor rule gap, I'm sorry, I'm really tired, and the more tired I get, the more economics jargon I use. It's typical. But to close that gap, estimates run from $5 to $10 trillion of quantitative easing. So very, very large. In effect, the Fed would have to buy the entire outstanding debt of the U.S. government. There's a case for doing that. I mean, I think actually that they should, but will they do it? I have my doubts.
Okay, so here we have a first answer. The first answer is we need to reflate, right?
Right.
We need to reflate. That's apparent to most people. Can the Fed do it? Well, perhaps we can learn something from the first reaction of the monetary authorities to the crisis, right? I mean, when they reacted first in the fall of 2007, we are seeing these balance sheets ballooning, and at the same time unemployment increasing. So.
Well, but that's you have the problem that there are other things happening at the same time. I mean, you have to be a little bit careful. You know, if you look at the correlation, you would basically say that fire departments cause disastrous fires, because whenever you see those sirens coming, that's when the thing burns down. Anyway.
I'm talking about ineffectiveness.
Yeah.
That's
right. It was. No, I actually think that quantitative easing in the crisis was actually more effective than it's likely to be right now, because you had a period of really dysfunctional markets. When nobody is willing to lend and you have extreme disruption, when the commercial paper market has just disappeared, that's when having the central bank buy some commercial paper actually gets quite a lot of traction. But we're not in that situation now. Yeah. It's precisely because the markets are sort of normal that it's very difficult to get leverage now.
Okay, so in the second stage of that crisis, what we saw was a mix of monetary expansion and fiscal expansion of a strange type, right? The U.S. government especially was beginning to purchase securities, to bail out banks and so on. Some funny people were talking about socialism in the United States at the time. Did that work or not? My impression is that it did a lot of good work, but you yourself, I remember, in a book of yours, point out that what needed to be done at that point was to save the financial system, which was close to meltdown, even though the damage was mostly on the real side of the economy.
Well,
Not
exactly. I mean, this is all really about financial things. But the way I would say it is that the bursting of the bubble had two kinds of effects. For the U.S., I think we can actually do this. At the U.S., the collapse of the housing bubble eliminated around $8 trillion of paper wealth. Of that, around $1 trillion was really exposure of the financial sector through various routes, but or maybe a bit more than that. But let's say $1 trillion. And the immediate concern was that $1 trillion of losses in the financial sector can have vastly disproportionate effects because it can collapse that sector. Because that sector is so highly leveraged, because it's so strategic, that terrible things can happen. And so it was urgent to prevent that piece of the losses from wreaking severe damage on the financial sector, which was done. The trouble is that you still have the other $7 trillion of losses, which is mostly household. And that's that we never found a way to resolve, and it's that other part that is a continuing drag on the economy. So we did the right thing. I mean, I think the U.S. government could have gotten a better deal on the financial rescue, but it did the right thing. But the problem was that was solving the acute phase of the crisis. That we got through the, oh God, we're all going to die phase of the crisis pretty well. But then we acted as if, okay, now everything will be fine, and that was what was wrong.
Right, good. And that takes me to the third stage of the crisis when, let's call it November 2008. You know, the U.S. has two governments at that point, right? Two presidents. Yeah. One is elected, but is not a president, and the other one is a president, but he cannot act on 2009 fiscal year expenditures or taxation, whatever. And the Chinese dropped this bomb, $586 billion deficit spending, right? Well, that's what they do.
Well, China, yes. Now, China is very. Right. I mean, China does this enormous stimulus very fast. Right. Two advantages. One, no need to pass legislation, and two, no need to police to avoid large-scale corruption. So those are things, unfortunately, that we cannot exactly emulate in Western nations. So, although it's worth pointing out actually that South Korea did a large, fast spending stimulus while actually being a functioning democracy. But yeah, the Chinese did a massive response in a way that the United States could not. I will say though, I think it's probably not true to think that if we had only responded really forcefully in November, December 2008, that everything would have been solved. Because it wasn't just the loss of confidence and the crisis. There is the debt overhang. And for that, you need not just avoidance of crisis, but you need growth for several years. You probably need some inflation. So I don't think it was, but yeah, we could have had a better response than we did then that period of essentially nobody in charge was bad. One thing I should say, if you want to tell a terrible story about the future, not this dreary story, but a really scary story, suppose that we do in fact manage to have another banking crisis. Suppose that the foreclosure problems are worse than we think, or suppose that there really is a major sovereign default that shakes the system. The United States, after Tuesday, is going to be in very much the situation you were describing for November 2008. We're going to have really, it's not clear exactly who's going to be in charge, if anyone is, and it's not going to be clear that any kind of rescue package could be arranged. If there was a call for another TARP type rescue, I think there's no way it would pass the U.S. Congress. So we actually are if you want, I think it's a 5 or a 10% probability, but we could, if we work at it hard enough, we could manage to have a total meltdown even now. Just wanted to encourage everyone there.
Just in case the acronym TARP is not familiar to somebody, stands for Troubled Assets Relief Program.
Yeah, there was the $700 billion in asset purchases that were used to rescue the banks, which, by the way, appears will be very nearly break even. It was not a loss of money in the end, but it could have been.
Yeah. Now you see that perhaps the point I'm going to lead to is about spending, actual deficit spending, because at the beginning of the third wave of reaction, everybody was very happy about government deficits, right? And I remember everybody cheering. Including you, even though you even said it is not enough when Congress in February 2009 approved this $787 billion deficit.
Right.
So spending was good back then, and deficit spending was good, right? Whether done in the Chinese way, which was pure spending, or the U.S. way, which was tax reduction, transfer to states which otherwise would have contracted, right? So it was a good thing, was it, back then?
Well, yeah. I mean, it's. I think the best estimate, if we had not had the Obama plan, the unemployment rate in the United States would be close to 12% instead of 9.6. It definitely is better, but of course, my greatest fear in early 2009 was that it would be enough to limit the rise in unemployment but not to produce an actual fall in unemployment, and that this would lead to that politically that voters don't react to counterfactuals, they react to facts. And if you can't show an actual improvement, then people will say, oh, your policy failed, and you won't get a chance. There won't be a second chance. I wrote that in about 10 columns in early 2009, and I'm sorry to say I turned out to have been right. So this is our problem.
Yeah. Well, now all of a sudden, on October 22nd, 2009,
Yeah.
Fitch declares the Greek government's debt untrustworthy. And I made the point on the 23rd of June in this very classroom
Right.
or room that sounds fishy to me. Because, the old government had resigned 17 days earlier. There was absolutely no way one could hold the new government accountable for that thing. And yet, nothing had happened. Up to then, up to the summer of
Right.
2009, government deficits were good. So
Yeah.
we were all Keynesians. And then all of a sudden, Professor Berthellet, who is the person over there, pointed out that since my wife is Greek,
Right.
I have some sort of prejudice in favor of Greeks. But let me hear something about these rating agencies. We
Well,
know
the
that
rating
Congress has been looking into their behavior for months and
Right.
years now.
Well, rating agencies their history on sovereign debt is really very bad. Their history on domestic debt, we now know, on mortgage-backed securities is bad. But on sovereign debt, first of all, they're almost always a lagging indicator. Greece would be an unusual case where they moved in advance of the market. Normally, it's only after everyone has decided that there's a problem that the rating agencies notice it. But also, they tend historically to hold governments to be much more pessimistic about sovereign debt than about private debt, to be eager to downgrade governments in the face of what are not necessarily serious problems. Now, my understanding is Greece is it is very hard to see how the Greek thing works. It's the sin was not to catch it long before, but in other cases, I don't know if it's widely known that Moody's and Standard & Poor's both downgraded Japan in 2002. One of them, I can never remember which, actually downgraded Japan to a level below Latvia. And they said, no, look at the deficit's terrible thing. We can't see how this is going to, it's really bad. And the interest rates on Japanese debt rose briefly and then fell again. And here we are, 8 years later, Japanese 10 years are trading at about 1%. So they were completely wrong. They had a much, much too pessimistic view. And it has not been helpful. A lot of people actually in the U.S. they look at the behavior of the rating agencies and say the U.S. will hit the wall in 2020 or 2019 because that's about when we would expect the rating agencies to downgrade U.S. debt. And I say, well, who knows? But in any case, remember 2002 in Japan. The rating agencies actually know nothing about this.
Now this is very relevant, of course, for our discussion because perhaps not everybody in this room, most do, but not everybody perhaps knows that what rating agencies say is used or taken into account by central banks in order to decide what type of assets they're going to borrow or take as a collateral or purchase from commercial banks, right?
Well, that's part of the...
That's part of the problem.
Part of the problem with doing unconventional open market operations is that you either, short-term government debt, you know what you're doing. Long-term government debt, you more or less know what you're doing. Other things, it's been very difficult. The Federal Reserve has moved away from, for a while it was buying a kind of alphabet soup of, it had all of these programs to buy commercial paper and so on. And it's pretty much phased them out, in part because they were relying on the rating agencies to tell them which things they could buy, and the Fed is not stupid. They knew that they had no idea whether the stuff that was being called AAA was actually good debt or not. And I think they're all kind of relieved to be out of that business. I'm not sure that the rating agencies will matter. The Fed is not going to stop buying U.S. government debt, even if Moody's and Standard & Poor's downgrade America. But it's this problem. We've created a system which is really is full of moral hazard and distorted incentives, and what we really should have done in financial reform was to establish an independently financed but official rating agency, but it was never even on the table.
So may we say that you didn't find it surprising when Jean-Claude Trichet decided, I remember 21st of May, to disregard the rating of agencies?
I didn't follow that one actually, but I'm not surprised. It's look, the central banks are in there. I think the ECB needs to act as a guarantor of European stability, not like a risk-averse investor. My problem, I think, with the ECB is it's acting too much like a risk-averse investor, and it needs to. I have my complaints about my former department chairman, but if we could clone Ben Bernanke and send him to the ECB instead of Axel Weber, that would definitely be an improvement.
And so, with this decision on the 21st, I may be wrong by 24 hours, I don't remember, 21st of May, Jean-Claude Trichet solved the Greek debt problem, didn't he?
Well, no. Right, Greece is now not reliant on the market for financing for the next few years, which is fine if you think that the situation will have resolved itself in the next few years. But I don't see how that's possible. You both require, Greece is being required to make an incredible move to primary surplus, which is a huge burden fiscally, and it's going to be facing declining nominal GDP, both because of the effects of the fiscal contraction and because of the, in effect you have an overvalued drachma, even though you don't have a drachma, and that's deflationary impact. So if you believe the IMF program, I mean, 4 years out, debt to GDP for Greece rises from 115 to 140. And I think the IMF is too optimistic. So I don't really see how this works. I mean, maybe it just works out much better than, that there's mysteriously strong export strength or something. But no, I mean, what the various European rescues have done is they've bought Greece time. So nothing happens today or tomorrow, or next year unless there's a banking panic. But I don't see how time solves the problem.
Okay, before we move on to another type of questions, let me finish on this point for a second. So, monetary policy helped us a lot in the first stage of the crisis. It certainly, half a trillion dollars now plus another $500 billion monetary expansion over the next 6 months will help, but that doesn't look like the solution. Climate policy doesn't seem to be in fashion very much anymore. Now let me ask the real question. Why couldn't we have a movement of economists led by Paul Krugman saying that we see no reason why a coordinated fiscal expansion throughout the world could be implemented and could possibly be the best way to drag the world out of this?
Well, this is where we have the problem that not only is there a lack of unanimity among economists, there's a significant fraction of the profession that will oppose anything I propose. Whatever I say, they will propose the opposite. What can we say? So no, if you're willing to take, if you're willing to, if you believe that getting me and Joseph Stiglitz and a few other people together in a room would be able to persuade the world, that would be great. But in fact, we've actually gotten me and Joe Stiglitz and a few other people in a room with President Obama, and we couldn't even persuade him. So I think we're not doing too well here.
Are you turning Republican now? What's happening? Yeah, well, but I'm not convinced, because this monetary expansion story is really how shall I put it? Wrong at the very foundation, isn't it? I mean, you keep pumping liquidity into the system. Call it quantitative easing, call it qualitative easing, call it whatever you want. It's the old image of the horse being led to the water, but you can't force him to drink, right?
Well,
Isn't that so?
There's a little bit. I mean, part of the point is actually it's a little hard to draw the distinction between monetary and fiscal policy at this point. The only reason you can get any traction here is because you are in effect taking on risks. You're taking maturity risk off the hands of the private sector and putting it on the public sector. So that is a kind of a fiscal expansion, but it's administratively done by the central bank, and it should matter a little bit. But yeah, if I go back to when we had at Princeton in 10 years ago, we had a little group of economists who were all worried about the Japan problem. So it was me, it was Mike Woodford, if you're do macro, and Lars Svensson, who's back at the Riksbank, arguing with his colleagues, and Ben Bernanke. And there was a little bit of a division between the Bernanke view, which was that quantitative easing, as we now call it, could do the job, and the view of myself and Svensson that you really needed to change inflation expectations. And we now get a real-world test of how effective quantitative easing can be, but I am skeptical that it can be enough. I think you try it because at this point you try everything, but I don't have high hopes.
Let's get into the dreaming part now.
Okay.
Forecasting the impossible. What is your feeling about the international division of labor in the longer run? Basically, the questions here ask, in different ways. They ask, look, we saw America deindustrializing. We saw manufacturing capacity moving to lower income countries. This has generated some sort of not some sort, just generated higher income growth in those countries, and we are all very happy about that. And then we are observing this strange situation in a three-country model, U.S., Europe, and China. Let's call it China, in which one country does research and development, one country does manufacturing, and the third country is not clear what he should do. So.
I think that's actually, I think this is provided we can get through the macroeconomic crisis, this is something of a self-correcting problem. In 2007, before everything fell apart, we were seeing, I think, a trend towards restoration of a reasonable equilibrium there. At that point, the dollar was fairly weak. You were actually seeing a sharp revival of U.S. manufacturing trade, and U.S. manufacturing production was on its way up. We actually had some serious labor shortages in America at that point, which were for things like machinists and pipe fitters, because manufacturing was doing very well. And if we can get through all of this, then I think a reasonable value for the dollar, coupled with rising wages in emerging nations. I mean, China is facing substantial upward wage pressure. It starts from a very low level, but I think we can actually see that this would all work. If there's an Achilles heel to the prospects for a generally reasonable world economy, it's actually resources. I mean, in the end, I don't think there's going to be a problem that the U.S. will do nothing. We will always have comparative advantage in some things, but what is an issue is that we're on our way to having the first world population rise from 800 million to 3 billion, because we bring in large parts of Asia, and at that point you've got 3 billion people competing for limited supplies of oil and copper and so on. But I think we can handle that. I think it was self-correcting. I think it will be self-correcting if we ever get through the macro mess. And there's a lot more manufacturing in the United States than people realize. There's a lot more. There's stuff we can do, and and Europe is never understood. Germany remains a mystery, how they manage to actually continue to export with labor that expensive, but they do. And Italy, we were having this discussion in a previous meeting about Italy, and I said that if I looked at the numbers, I would have a really, really dire view of Italy. But the problem is that would have been true any time in the past 40 years, and still you are here. So.
Well, possibly we're here not as rich as we were.
Oh well.
Huh?
Well, I think yeah.
Let me move on to another important question, which has to do with the exchange rate. Of course, the exchange rate, say dollar renminbi, but also the exchange rate system. Because the second part of this question asks about what do you feel about the dollar being, in the longer run, the reserve currency, the first most important. So two questions.
Yeah. So renminbi. What China is doing is very bad. Undervalued exchange rate at a time of world and liquidity trap is a predatory policy. And what makes it really bad is the Chinese don't need this. The Chinese are actually raising interest rates to head off inflationary pressures. And what they should be doing is allowing the renminbi to appreciate instead. And then the question really is not whether what they're doing is bad, but exactly how do we deal with it. And I don't think there's any chance of getting them to move without at least the credible threat of countervailing duties. So I'm a free trade guy, but there are times when you just have to say, look, you do need some sanctions in the system. And by the way, this is one thing Obama can do. He won't be able to pass stimulus legislation. He won't be able to pass if he wanted to pass legislation saying that the sky is blue, the Republicans would oppose him. But if he wants to impose tariffs on Chinese exports, he'll have 80 senators and 400 representatives voting with him. So this is one thing that we can do. Exchange rate system. I'm sorry. So the question was what?
Dollar as a reserve currency.
Oh gosh. I actually think the dollar's role has gained a while here. I mean, actually, let me give you there are only two credible candidates for reserve currency in today's world. The renminbi it can't because it's not convertible. The yen is just not a big enough base. So we really are talking about dollar versus euro. And the euro has just taken a large hit in its prospects for supplanting or even being co-equal with the dollar, because one of the things you need for reserve currencies, you need a broad, deep pool of assets that people can invest in, and particularly you need a broad, deep government bond market. And the Eurozone looked fine as long as a Eurozone government bond was a Eurozone government bond, as long as it didn't matter which country it was from and it was all the same thing. But now when you have when Bunds and Italian debt and Greek debt are all highly different, you've got effectively a bunch of smaller markets, none of which is comparable to the dollar. So I think actually we've got at the moment, we have no real alternative to a dollar-based standard. That said, does it matter that much? I mean, if you're worried about seigniorage, if you're worried about who holds your stuff, who makes you zero interest rate loans by holding your currency, the actual nominal value of euros in circulation is larger than the value of dollars in circulation. In both cases, you have a lot of currency being held outside the region, mostly for dubious purposes. So basically, Latin American drug smugglers do their business with $100 bills, and Russian gangsters do their business with €100 notes, and we're both doing fine at collecting a lot of seigniorage.
I believe this is going to be the last question, even though there are many more, but it is about 8:30 now. Here somebody is giving you a lecture in free trade by quoting The Economist.
Okay.
I'm quoting The Economist now. This newspaper is not convinced of the effects of tariffs and currency wars. More than one victim will be counted if this happens.
Well,
this is The Economist.
So, and am I supposed to be impressed by the authority? I don't know.
I don't know. That depends on you.
I will quote. I will closely quote Paul Samuelson, who had an excellent paper in 1964 called Theoretical Notes on Trade Problems, in which he said, in the face of persistent unemployment, all of the mercantilist falsehoods become temporarily true. This is, yes, free trade is a very important thing, but if you're going to have a world which is unable to provide enough demand to achieve anything like full employment, then a country which pursues a deliberate undervaluation is mercantilism is real. It does real harm. It's no longer the case that they're doing us a favor by sending us goods cheap. And in that situation, it really becomes a political, a strategic question whether you think whether you think there may be unforeseen consequences, to trade action, but the economics for imposing temporary, for imposing countervailing duties on China is perfectly standard, perfectly straightforward. I think people. And maybe these are my last words here. People often think that economics is about slogans, that there are simple phrases, free trade good, and what it is, and economics is about models. It's about a picture of how the world works, and that's a picture that tells you that free trade in most circumstances is good, but there will be times when it doesn't work, when that argument doesn't work. And here we are. We're in a really weird world right now. We're in a liquidity trap world. Is a world in which many of the usual rules do not apply, and this is just one case of those. And we have a problem, which is that not enough people in policy understand that.
The very last question, even though it is 8:30 sharp. How did you decide to study economics?
Oh, gosh.
It is a true question.
Right, but this is in the public domain. I've explained this,
Please do.
So I'll tell you the story. The question is, do you read Do you read science fiction? And in particular, do you read old classic science fiction? Because Isaac Asimov, the great science fiction author, had a series of novels, the Foundation novels, which is about, in the distant future, how galactic civilization is saved by a group of social scientists, the psychohistorians. And so when I was 16 years old, I loved those novels, and I wanted to be one of those people. And the trouble is we don't actually have that kind of social science, but the closest we have is economics. So what I'm doing is my best way of living the imaginary science fiction life that I imagined 40 years ago. Not too bad, actually, as it's turned out.
I thank you very much for that answer, because I beg students to read science fiction.